Well, thanks for having me on, Wilfred. I guess the best way to think about the valuation is, as the great Larry David once said, a good compromise is when both parties are dissatisfied. And when you think about what we had here was we had an initial pricing range of 21 to 24. The investment community pushed back, pushing the price down to 17. And as it rallied back up, we found the buyers and the sellers compromised to a point where we got back to where the initial pricing range was. So from a valuation standpoint, the market spoke. As you look at it compared to its peers out there, part of that will depend on how well the story can be executed and what the company can generate, and whether or not the investors feel that it's comparable to some of the other major players out in space.
On that question of execution, what are their expansion opportunities?
When you think about where this company was historically as a pure play restaurant company with a franchise model, they've reversed that and they've taken it a step further. They've bought back in a number of their franchisees. They now have about 85% of their domestic business controlled by the company. What they've done is they're approaching this with a hub and spoke approach. So they have these theater stores where they'll produce the donuts. They also have factories. They'll ship that out to their ancillary stores, their secondary stores. But in addition to that, you talked about New York City and a lack of the number of pure Krispy Kreme stores. But if you walk into a Walgreens, you'll find kiosks and the availability to buy fresh donuts on a daily basis. In addition to that, they have a number of kiosks out there. So they're looking to grow from 9,000 units to 15,000 units globally.
It's interesting because if you look at a lot of the restaurant companies and a lot of their competitors, Brett, it's the other way. Doesn't Wall Street like the asset-light model? Wasn't it always about selling off the franchises and just, owning the brand and running the company? Wasn't that what was embraced? Why is Krispy Kreme going the other way, and is that going to be a problem ultimately for Wall Street?
I think that's part of the execution risk that you bring into play, as well as the company talks about an asset-light model, limited capex as they build this hub and spoke. They're taking it from a little bit of a different approach. As I said, they have a fresh business that they're shipping out to the retail marketplace that will help them expand out using their existing infrastructure for production, but other points of distribution. There is that risk associated with a limited service player that is more owned than not owned. We've seen many of the major QSR players pushing more towards that franchise model, where you put it in the hands of the operators and let them assess what the best way to spend their capital and time is.
Shepard Smith here. Thanks for watching CNBC on YouTube.